Hello and welcome to the ICAEW knowledge level paper. This is the accounting paper. And what we're going to do within the accounting paper is we're going to take you through everything to do with debits and credits and financial statements so that at the end of this paper, at the end of this set of courses and online recordings, you'll be able to prepare a full set of financial statements. Fabulous. More importantly than that, you'll be able to pass the exam, which is really important. Now, within the first chapter, what we look at is a generic introduction to accounting. And what I've done with this chapter is I've actually split it down into two separate component parts. I've split it down into two parts primarily because there's an awful lot of theory in here and you need to understand this theory. If you can understand the theory, when we then start applying it to real life situations within the rest of the study manual and within the rest of these recordings, you will find that it all just makes common sense. So understanding the theory behind everything is absolutely critical. And what you'll find is when you get to your final papers, when you get to your corporate reporting paper in your final year, understanding the theory behind all of the different standards will put you in a great stead to pass that final corporate reporting paper. Now, within this chapter, the different areas we're going to cover, we're going to start off with an introduction to accounting and financial information, and we're looking at it from a user's perspective. Then what we'll do is we'll have a look at the objectives of those users and try to identify what type of financial information they actually want. Once we've done that, we can then start talking to you about the types of financial statements we produce. We look at formats of financial statements. Purely from a theoretical perspective, we're going to look at the actual examples a little bit later on. We then have a look at the regulation and framework of the accounting profession. And then we have a look at the qualitative characteristics of the information that we're going to provide. And at the very, very end, we have a look at principles and concepts, which will determine how we do everything. So if you can learn the principles and concepts, you'll understand exactly what we're trying to achieve and how we're going to achieve it. Now, within this chapter, there is a little bit of ethics. In every single exam that you take from here on in, there will be something to do with ethics. Always something to do with ethics. You need to make sure you get those nice, easy ethical marks. You need to make sure that you understand our code of practice. You need to understand the principles behind our ethical code. Now, if you're taking this paper by itself, you need to make sure that you're happy with the ethical code, and we'll come to that a little bit later on. If you're taking this at the same time as assurance, wonderful. You'll actually cover the ethical code in assurance as well. You cover it in more detail in assurance than you do in accounting. So what you can do with the accounting paper is skip through it a little bit because you're going to absolutely nail it within the assurance paper. Now, with any more ado, let's get stuck into what we're trying to achieve here and actually get some understanding of what accounting is all about. So the first question we ask ourselves is, what is accounting? Well, accounting is all about providing financial information. So accounting is all about providing financial information. It's not just about providing financial statements and producing sets of financial statements for published PLCs. What we are looking to do is provide information to users. Those users will then make a decision. So the users will then make a decision based on the financial information we've given them. So what we need to do is understand who our users are, understand what type of decisions they have, then we can provide them with that type of information. And that's what accounting is all about. That's why it's absolutely critical to record these types of financial transactions so we can record what's happened in the past so our users can understand the impact of their previous decisions. So the users can understand the impact of their previous decisions. If they understand previous year's financial information and then their decisions and then the impact their decisions have had, they will now be able to potentially make the same decisions or a different one based on the current year's financial information to generate a different effect. So if our users understand the impact of their decisions, we can now tell them whether or not that was a good decision or not by giving them financial information. They will then decide whether or not to make that same decision in the future. Does it matter how we record financial transactions? Absolutely. Our users have got to understand the information, and that's really important to me. And one of the things we do throughout all of our accounting standards is we look at what do our users want to see, what type of decisions are they going to make, and how can I present the information to these people in such a way that they will understand what's happened, and then they can make a better decision in the future. So we need to make sure that our users can understand everything that's happened, including the impact of their past decisions. So including the impact of their past decisions. So what we need to do is start thinking about who our users are. Now, our users are a huge list of individuals, and our users now become known as stakeholders, because all of our users have got a stake in what this organization or what this company is doing. So all of our users become stakeholders. And the types of stakeholders that we can have will include this huge, big, long list of different types of stakeholders. So all of these different groups have got a use for the financial information that I'm producing. So all these different users have got a use for the financial information that I'm producing. From an owner's perspective, if I'm a shareholder within a company, I want to know how well that company's doing. I want to know if I can get my paws on some sort of dividend payment. I want to know whether the company is doing well in the past and whether I should now expect it to do well in the future. I want to make a decision as to whether I should hold on to my shares, buy some more, or potentially sell them. So I've got market-based decision making there with regard to my owners if they're shareholders. With regard to management and directors, these guys will be making decisions on a day-to-day basis to run the company. So my management and my directors will make decisions on a day-to-day basis to run the company. Now, this gives us quite a keen difference of what these guys need. Owners are interested in financial statements because they'll determine whether or not they can get a dividend payment, because there are certain rules around dividends, which we'll come to a little bit later on, which say you can only pay dividends from profits which have been realised. However, those profits, when they're realised, may derive a dividend payment next year. From a management perspective, I need to make a decision today. I need to make my decision based on information available today. So what we have is internal users, such as management and directors, who can get their hands on up-to-date information and potentially even prospective information. So we're trying to predict the future. So our management and directors are internal users who can get access to lots and lots of information, including prospective future-based information. The owners can't get hold of that. Now, because of that, we've got an entire different tranche of accounting called management accounting. Management accounting provide information to management for business-wide decisions, and that's why you have the management information paper. So the management information paper looks at management accounting issues and providing information to management for decision-making purposes on a day-to-day basis. This accounting paper looks at the majority of our other user groups. So we've got people such as the government and HMRC, so Her Majesty's Revenue and Customs Authority. They want to extract their pound of flesh from our organisation by taxing us. That tax charge will normally be based on profits. There will be adjustments in there. Those adjustments you'll cover within all of your different tax papers. The banks or lenders, they will provide us with debt capital, so they'll help to fund the business through debt capital, so they'll make a loan to the company. That type of loan will have an interest charge. That interest charge has to be paid, but the banks and lenders want to reduce their level of risk. So they'll look at the financial statements that we produce and they'll say, does this company look like it's high or low risk? If it's low risk, they charge me a lower rate of interest. If it's high risk, they charge me a higher rate of interest. Oh, hang on a minute, that now means that the look and feel of my financial statements will determine my interest charges. Yes, that's true. And that's why we've got to be careful with this. It's very easy for me to say, oh, I'll pretend the financial statements look brilliant because my interest charges will now be lower. That is not ethical. You've got to stay true to our ethical concepts. And one of our key ethical concepts is the idea of being objective, which means unbiased. So we just tell everybody the truth. You don't have to be blunt, but you do have to tell them the truth. Suppliers and customers are interested in whether this business is still going to be around in the next year or two to make sure that I can fulfill any new orders to customers, or I can potentially keep on buying stuff from my suppliers, which means that suppliers and customers are interested in whether or not this company will be a going concern. And the going concern concept is a critical concept. We're going to come to that on part 2 of this chapter. We then also have financial analysts who will make their money by giving advice, usually to shareholder groups. So they'll have the same type of informational needs as our shareholder groups. And then also the general public will have an interest in here as well. And what will happen is we will understand, as directors of a company, we will understand that the general public have got an interest in what's going on, and we will provide them with additional information. That additional information is not usually financial in nature. It tends to be more narrative, sort of wordy based information. So there'll be various different narrative reports, such as this is the impact we've had on the local community. This is the impact that we've had on a local forest. We've cut down lots of trees, but we've planted even more trees. So we're trying to sustain the overall economic and environmental environment. That type of thing can be really, really important to me. Now, within this study manual, every now and again, we will come across various different worked examples and interactive questions. We will do the majority of the interactive questions and the majority of the worked examples. We will not do them all. If I think it's one that's not particularly useful, or I think it's one that we've covered in too much detail already, we'll just skip past it. But to show you how these things will work, we've got interactive question number 1. And what I would like you to do is whip your study manual out, please, guys, and have a look at your study manual. And I'm just looking at interactive question number 1. And it says interactive question number 1, accounting information. It's easy to see how internal stakeholders, so there's our stakeholder idea again. So it's easy to see how internal stakeholders access accounting information. So a manager, for example, can just go along to the accounts department and ask the staff there to prepare whatever accounting statements that manager specifically needs. But external users can't get access to this internal information. How in practice can a business contact or a financial analyst access accounting information about a company? Well, what actually happens is in the UK, companies are expected to file their financial statements. They file them with Companies House, and when you file that accounting statement at Companies House, it puts the information within the public domain. So everybody can have access to it. So everybody can have access to it. There may be a small charge, but everybody can now get access to it. If this company is a listed PLC, so a public limited company, and we'll talk about the difference in types of companies when you get to your law paper, but if this company is a listed PLC and quoted on a stock exchange, they will also have stock exchange listing requirements, which means they have to provide additional financial information on an ongoing ad hoc basis. This additional financial information can include things such as interim financial statements, so not just a 12-month period, maybe an interim 6-month period, and also trading statements every quarter to say this is what's happening and this is what we think is going to happen to us in the current market. So there are other areas where we can generate additional financial information to make decisions. That can be really important to me. So the next thing I need to look at is the key objectives within our accounting system, if you like, within our provision of this financial information. And what I need to do is I need to work out my primary stakeholders, and my primary stakeholders will be my owners. So my primary stakeholders are my owners. So what I do is I look at what the objectives of my owners are, and I try to make sure that I can fulfill their objectives. So my key stakeholder groups become shareholders. So my key stakeholder group become shareholders. Shareholders are interested in what's happened in the past, because I'm going to look at previous year's performance. And we look at the previous year's performance by looking at a statement of profit and loss, which we'll come to in just a second. I'm also interested in the current up-to-date financial standing of the company. That will be done through a statement of financial position. If you're working within the UK environment, we call those things balance sheets. Now, this entire paper that we're doing of the online recordings for will be specifically the international version. However, I do talk to you about the UK side of things as well, so you can use it for the UK paper as well. So what we're going to do is we're going to produce a performance report, which is my statement of profit and loss. We're also going to have a financial standing report, which will be my statement of financial position. If we want people to use this information, and I do need them to feel comfortable using this information, I need my user groups to feel comfortable and to trust what I'm producing. So I need my user groups to feel comfortable and to trust what I'm producing. So what we do as a profession is we have codes of conduct with regard to our ethical behavior. So we have got specific ethical principles that we must adhere to all the time. So that regulates us as individuals and our behavior. What we also have is accounting standards, and accounting standards will tell us as accountants how to produce information, how to prepare the information, then how to disseminate that information. The accounting standards tell our user groups what we've done and how we've done it so that they can understand what's happened. So the accounting standards are basically, I don't want to say rules because it's not quite as hard and fast as rules, but it tells me how I should do things, and then my users will understand that and they'll understand what I've done and why I've done it. Now, our accounting standards form part of what we call GAAP. Now, GAAP is generally accepted accounting practice. It's also known as generally accepted accounting principles, but accounting practice is probably a little bit more encompassing, so I'd prefer us to use that one. So when I talk about GAAP, I'm talking about generally accepted accounting practice. Now, we have got different types of GAAP. We've got international GAAP, and we'll come to some of the alphabet soup in just a second. We have international GAAP, which looks at the worldwide environment. We also then have various different domestic elements of GAAP, such as UK GAAP. You could also have US GAAP, which would be applicable to the USA. So GAAP is either international or specific to that domestic jurisdiction. GAAP, as a general rule, encompasses 4 things. Now remember, this paper, the vast majority of the marks, 60% of the marks, are going to come from multi-choice questions. Multi-choice questions are usually pick 1 from 4 or sometimes 2 from 6. If it's a 1 from 4, here's 4 different things that are going to encompass my GAAP. I'll take one of them out and throw something else in instead. So you need to learn this. So GAAP includes legislation. That legislation would include Companies Act 2006. So it would include Companies Act 2006 and any other legislation with regard to the specific type of business that you're doing the accounts for. It also includes accounting standards, and we're going to come to what the accounting standards are in just a second. So it includes accounting standards. It also includes accounting concepts, and we're going to look at some of the accounting concepts in part 2 of this chapter, and also individual judgment. Individual judgment will be determined by our behavior, and our behavior is regulated by our ethical code. So the individual judgment, you're allowed to do what you think is best, but you've got to do it in a very specific way. There is also the stock exchange listing requirements, which means if you're a listed PLC, so a listed PLC which is listed on a stock exchange, you have to provide additional information, which then forms part of my GAAP. Now, what we're going to do is we're going to go through some of the alphabet soup issues now. You need to, I'm afraid, guys, learn what all of these things actually stand for. So what we've got is, I'm going to go through them just a couple at a time. We've got IFRS. IFRS stands for International Financial Reporting Standards. So that's International Financial Reporting Standards. These are the newer, I say newer because they're not brand new anymore, they've been around for about 20 years. So these are the newer international standards. IAS is an international accounting standard. They are the older international standards. Some of the IASs are still in effect because they haven't been replaced yet, but the IFRSs are replacing IASs over time. We're just taking a bit more time about it. So IFRS is International Financial Reporting Standard. IAS is International Accounting Standard. Slightly different. What we then have is IFRIC and SIC. IFRIC stands for International Financial Reporting. So International Financial Reporting Interpretations Committee. Interpretations Committee. IFRIC will interpret IFRSs and give us as accountants a better understanding of what the standard is trying to do and how it's trying to do it so that we can then apply it better. So IFRIC will interpret an IFRS and give us a better understanding. They sometimes give large numbers of examples of how to use standards in very specific situations, which is really cool. SIC is the Standards Interpretation Committee. The Interpretations Committee here, the SIC, they used to interpret IASs, so same sort of idea. So SIC goes with IASs, IFRIC goes with IFRSs. We also have CA 06, which is Companies Act 06, and that Companies Act 06 is the main piece of legislation which governs the maintenance and administration of companies in the UK. The Companies Act 2006 basically took all of the previous Companies Act legislation, which had gone back for years and years and years, binned it and started again. Companies Act 06 is a marvellous piece of legislation. It looks at every different aspect. It's a really, really, really powerful and very, very effective piece of legislation. And it's not very often that you hear people praising pieces of statute, but Companies Act comes in for lots of praise. It does lots of really good things in a really, really good way. FRSs are financial reporting standards. They are the UK version of our accounting standards. So an FRS is the UK version. So an FRS is the UK version of an IFRS. In addition to that, what happens is FRSs and IFRSs will usually cover the same areas. So you'll have an IFRS and an FRS covering the same areas, but some of the terms and some of the phrases that we use may be slightly different, because the UK terminology may be slightly different to the international terminology. So what we do with a UK-based standard, which is an FRS, is we make it very much bespoke to the UK environment. With an IFRS, it becomes more generic and is therefore applicable to the rest of the world. Now, one of the key standards that we have, we have is IAS number 1. This was the first international accounting standard. This has been out for donkey's years. And what this does is it says that the primary financial statements that you need to produce, will include a statement of financial position. That is my statement which tells me the current financial position. That gives me an indication of the wealth of the company at a specific point in time. We then also have a performance statement. That performance statement is my statement of comprehensive income. And that statement of comprehensive income can be split down into a statement of profit and loss and then a statement of changes in equity. Statement of changes in equity is not examinable within this paper, so we're not going to talk about that anymore. The statement of comprehensive income basically becomes my statement of profit and loss. We then also have my statement of cash flows. Cash flows become very interesting to me as a user because the way that a company uses cash will determine whether or not that company stays in existence or not. It's because you can make lots and lots of profits, but if you don't have cash, the company falls over. So the statement of comprehensive income, my statement of profit and loss, shows how profits are made. Statement of cash flows shows how cash is generated and how cash is used up. And that's really important. It's so important, it's potentially going to be your 40 marker on this paper. So the 40 marker on the paper will either be prepare a statement of cash flows or prepare a statement of financial position and a profit and loss statement. Both of them are actually pretty good. We will go through all of those in a lot of detail as we work our way through the paper, so don't worry about it too much just yet. We'll just go through it one step at a time. The statement of financial position to start with. What this does is it gives me a list of all of the assets and all the liabilities under the control of our organisation. So it tells me all of the assets, which are usually good things, tells me all the liabilities, which are usually bad things, which are under our control. Assets and liabilities are defined with reference to creating additional resources in the future, and it's economic resources. Normally means cash, so normally would mean cash. So it gives me all the assets and liabilities under the control of the organisation, which means it's the stuff the directors can make decisions over. It also tells me my ownership interest, and the ownership interest is known as equity. The ownership interest will include, so the ownership interest, which is my equity, will include share capital, share premium, any retained reserves. So share capital, share premium, and any retained reserves. Now, the statement of financial position, when it gives me all of these different assets and liabilities, and then the ownership interest as well, what it's actually doing is it's telling me the economic resources available to my management group. So it's telling me the economic resources available to my management group over which they can make decisions. It also tells me, we're going to jump it down a little bit now, it also tells me about the short-term liquidity. So it talks to me about short-term liquidity, such as how much cash have we got there? So I'm looking at short-term assets, such as cash and amounts of cash that people owe me. I'm also then looking at longer-term issues, such as longer-term funding. How is the business being funded in the longer term? Is it coming from large amounts of debt? So is the bank giving me a big loan? Or is it large amounts of equity, which means have the shareholders put lots of money in? That now allows me to see my financial structure. So the funding for my business activities will come from two sources, debt or equity. So the financial structure, the funding of my business will only ever come from debt or equity. Also, it allows me to see how adaptable my organization is to changes in the external economic and generic environmental environment. So how adaptable is my business to changes in things, such as if we had a huge banking collapse, such as in 2007, 2008, how adaptable is my business? If we had a global pandemic, such as in 2020, how adaptable is my business? The financial position statement will tell me how adaptable I have been and how I can now change what's happening in the future. When you come to your second year paper looking at financial management, we actually go through this in a huge amount of detail. This is absolutely critical to the survival of businesses. My statement of profit and loss, which is my performance statement, what this does is it details income and expenditure over a specific period, whereas the statement of financial position gives me a snapshot at a specific point in time. This covers a period, and what this statement of profit and loss will do is it will allow me to see the impact of management's decisions. It shows me the impact of how management have used those resources. So it shows me the impact of management using those resources. And what happens is the shareholders own the company, the directors and the managers they will run the company. We say that the directors and managers are stewards. So the directors and managers are stewards of the shareholders' assets. And the reason we produce these financial statements is to discharge a stewardship function. And what this does is it shows me how we've discharged our stewardship function. That's really important. So I'm looking to determine what the directors have been up to and whether they made good or bad decisions. That is critical to me. Now that brings me up to the end of the first part. And what we're going to do now, guys, is I want you to make sure you're happy with all of those elements first before you move on to part 2 of chapter number 1. But apart from that, thank you very much for your time and attention. I'll see you all on part 2 very, very soon.